Okay, we're going to take a quick break and find out what Richard Fogler is buying. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Actually, Richard corrected me and said we're not buying. What did you say?
We buy a few things a year. It depends. I mean, some years we're very active. We might buy 10% of the portfolio. Most years we add one or two a year. It's a lot.
So you're not buying these names, but you own these names. Is a good way of putting it. Yes. Okay, your first one that you own that you still like is Brookfield. Talk to me about your thesis on it, and then I'll bring up some counterpoints.
Brookfield is a new position for us. We've only owned it for 2.5 years.
Okay. Why'd you buy it then?
I'll tell you why I buy it, because we still own it. We like private equity. This company has I'll tell you why today. So why we bought it, it's up about 100% from where we bought it. Why are we still holding it? Why haven't we sold it? And the reason is very simple. If one were to look at Brookfield, has basically three, Brookfield Corp I'm talking about, not BAM or not the infrastructure or the other business. Brookfield owns some interests in some businesses. Brookfield Partners, Property Partners, all this stuff, infrastructure, business partners. That's about if you add that, the value of their carried interest that BAM owes them for appreciation that has happened in the fund. If you add that to the wealth solution business of a multi-billion-dollar insurance company, which is part of that. And if you add the investments they have in the funds of their own capital in their funds, you add that all up, it's about 50% more than the stock price.
Which is already trading close to an all-time high. And so you're saying it's undervalued.
It's undervalued by a third.
That's wild. And
it's not my fault.
No, but it also speaks to, I think, a penalty box that a Brookfield gets put into.
Brookfield has a bit of a penalty box. Oh, I didn't. Just to add one more thing. And by the way, they're increasing the assets under management by 15% or so a year. So 4 years from now, that's the $1 trillion they manage will be $2 trillion. And I don't see why that trend is going to change. So it's cheap, and it's going to be a lot bigger 3 years from now. That's our thesis.
So why is it in the penalty box?
Maybe a little history, maybe a little Bruce Flatt, who's probably as good as it comes in this business, but Canadian, and it's Canadian. It's not Apollo or Blackstone, although they're in the private equity business, the largest is Blackstone by quite a bit. It's got about $1.1 trillion in assets. These guys are pretty close to $1 trillion. The next one is Apollo. I guess it's around 750, 760. And then there's the KKR, and they start dropping off pretty fast.
You know who loves it? American who loves it is Bill Ackman, Pershing Square.
Yes, he
was big defender of Brookfield.
He bought it recently. Now, so Bill Ackman bought. He knows it very well. He bought a company called General Growth Properties at about 20 cents, and that went to that went to about $40.
He didn't buy it at 20 cents.
He bought it at 20 cents.
20 cents?
20 cents.
Oh, geez, Louise.
We actually owned it. We owned it. We bought it before him. We bought it was falling. We paid 60 cents. And
did you get out at 40?
Well, it's a whole bunch of pieces. We still own one of the small pieces, as he does, which is, but we sold all the rest. Yeah, I mean, most of it was taken out. Brookfield took out the biggest chunk, and so he's well knowledgeable about Brookfield and how they operate in their real estate business and everything.
Okay, you hinted about this one several times in the show, so let's finally discuss it. Uber. And I would bet that a couple of years ago, when Uber had just come out as a public company, this would not be a company that was on your radar. And so I'm curious how it went from that high-flying tech startup to a stock worthy of your portfolio.
Worthy may be a little strong, but we bought Uber in January this year, so it's actually a new position.
That's a new buy, yeah.
That's a new buy for us. And we bought it very simply because Uber, as you know, first of all, their business model is phenomenal.
By the way, it's already up 50% in 2025.
We paid $63. I think we paid 63. It's in 85, so it's
90.
I didn't know that. I guess I should have.
You're doing well. All this to say you're fine. Doing well on it.
Listen, we don't talk about the ones that didn't do well.
Good point.
Nobody does. But Uber's been great. But Uber's very simple. It is the standard in the ride sharing business and in the delivery business. And it does 160 billion a year. It's not a small company. But it has, because of the nature of the business, was not very profitable. They had to change management a couple of years ago. They brought in Dara Khosrowshahi. Dara Khosrowshahi has done a spectacular job at renovating the business and making on the track to profitability. This year it'll make probably somewhere around $10 billion. So when we bought it was pretty close. It was a pretty cheap multiple. Again, we don't use multiples, but I'm just using it as an example. But the potential is it's probably going to that profitability probably grow 30% for the next 3 years. The reason the stock was sold, but the stock had sold off. It had sold off because the expectation was that the driverless business is going to dominate the ride sharing business, and this might hurt Uber. We thought that Uber, with its market position, would just participate in, as they have just done. They've just done a deal with Waymo. They're running 100 odd cars in Austin, Texas. Those 100 cars are, every one of them, running a higher capacity than any of the drivered cars. I don't know if anybody
on the network in
Austin, in Austin at the moment. And this is driverless is going to be a big business, and they're going to be a big participant in it.
Your third pick is interesting. REITs. It's called SmartCentres REIT, and it focuses on, it's like shopping centers, right?
Yeah, it's like shopping centers.
It is shopping centers. I'm trying to picture. It's a little
if
penguin.
If you like Walmart, they are effectively the Walmart arm in Canada. They have developed many of the shopping centers, Walmart centers in Canada.
Like a Walmart anchored shopping center.
They have 25% of their current portfolio is Walmart.
Okay, but
is to Walmart.
People get nervous. People get nervous about shopping centers, especially as HBC goes bankrupt, the Bay goes bankrupt, and so this sector sometimes gets put. It's another penalty box. So why is now?
We buy things in the penalty box. If we don't buy them in the penalty box, we're paying 20. Buying something for $1 that's worth $1 doesn't sound like a great idea to me.
So what's the upside on this one?
I will tell you, we bought SmartCentres. I told you we bought 5 stocks on March 27th, 2020. One of them was SmartCentres. SmartCentres at the time was trading at $17, $18 a share. It was yielding, I think, 15%. But of course, the retail business was right at the first month of COVID. Nobody was ever going to go to a store again. You weren't even allowed to. And you could go through all these different things. And so the real estate businesses, all the real estate stocks died, and this was one. But if that's
like a lot died in March 2020, right?
Yeah, everything
And so
died.
for this to rise to the top of only 5 names that you're going to buy, that has to be
only
something.
5. I mean, we don't. But that's 5 more than we normally buy.
That's true, but still.
So, but the bigger thing was, if you looked at this, it yielded 15, 16%. So if we thought that people would keep buying, keep ordering from Walmart, our 15% was pretty good. It was in pretty stable shape. And so how much could we lose? The only way, like you might say retailing's bad, but like people are still, we still have to eat. We still have to put clothes on our backs. We have to take care of our kids. We got to buy school supplies. We got to buy all this stuff. And so, the Bay failed for lots of reasons that were Bay reasons, not the fact. It's not retailing is about to disappear. You're just not going to be doing it from the Bay. And so that was one thing. The second thing is Walmart wasn't SmartCentres by then is not just a shopping center. If you think about their shopping center, they are also they are now in the multidimensional housing business. They build residential, high-rise residential. It's run again by one of the smartest people in the country in real estate. Mitch Goldhar has built an enormous business, and he doesn't allow the grass to grow under his feet. They have 94 development projects in the works, which will be done over the next 10 or 15 years, but go up to 400 and Highway 7, and look at the buildings that are going up there. It's all.
Aren't we nervous about that? The front pages are covered with unsold inventory.
They're also okay. So he builds and sell. He sell all condo builders. Most of them sell out before they build. Over the last number of years, the condo business is so good, the price has been going up. A lot of the guys will keep 10% behind and will sell them when they finish 3 years later because I'm going to get that much more money for them. He's got 94 projects on the go. He's always got another project to go. He sells it out. It's much smarter. And I mean, it's not been a great business, but they're doing fine. The interesting thing is, if you look at most of the stuff he's building on the corners of his shopping centers. There's no cost to that land. That was incorporated in the thing. A condo, usually the cost of land is the equity to the developer. And over 5 years, if it's successful, sort of on average, they will make that equity back. So they'll double their money over 4 years or 5 years. So they make about a 15-18% rate of return on capital. And so if you think about it, and he's doing it on land that cost him zero, that's a bigger win.
The dividend yield is 7%, so that's still pretty healthy.
So I'll give you a simple statement. There is no piece of real estate that's anywhere tolerable that yields 7%.
That's a good point. All right, I think we'll leave it there. Rich, thanks so much for joining me.